Good afternoon, everyone. My name is Clint Coons with Anderson Business Advisors and Law Group, and I'd like to thank Sandy for inviting me on today to speak to you about asset protection and tax planning for traders. I know this is a topic that many people have not been exposed to before, just because a lot of people who talk about trading they don't discuss this particular topic because they don't know about it. If you go to your CPA and you talk to him about trading, he's most likely going to tell you, well, everything you put on your Schedule D, that you don't have any other options. Well, the reality is that if you work with a firm that understands trading, in fact, that the principals themselves are actually traders like myself, and I'll tell you a story about that, then you're going to find you have some different options out there when it comes to putting together a plan for your investing. And so this webinar is very timely because we're coming up on the end of the year, and if you've had a brokerage account that you've been working this year and you've seen some success and you have some expenses and you're looking to write those off and capture them, then I think now's the time to take some action. Get a plan in place, because as I stated, we've got about a month and a half left before we transfer into 2016, and some of these expenses that you've incurred this year, well, you're going to lose them. You're not going to be able to write them off. So I'm going to show you what you can write off, how you can write them off, the options that are out there for you, and why you should be taking some action now before we hit 2016. Unfortunately, people look at tax planning and they always call us in December and they say, I'd really like to do some advanced tax planning now. Well, truth be told is that tax planning of that nature should begin in January. So we always tend to delay, we procrastinate. Well, even though you may have procrastinated this year, there's still some opportunities for you. I'm going to share those with you, and I believe then that you can see some success from a tax standpoint before the year is out. Okay, let me tell you a little bit about Anderson. We have a firm. It's located in both Washington and Nevada. And in our Nevada, we have 4 offices in the Las Vegas market. We have 17,000 clients throughout the United States, and the attorneys are stock traders. That's unique, I think, when it comes to dealing with a firm, because we understand the issues that you're facing. As I stated, I myself was an active trader for many years. I am not as active as I once was, but there were days when I would get up in the morning, I would trade options, and by noon I would have made over $30,000. Now, those are the good old days, right, where you could do that, where there were a lot of premium in those options. Things have changed, but the strategies haven't. The same strategies I used then to help reduce my taxes on my trading are the same strategies that you should be using today for your active trading. Additionally, we have a tax practice inside of our firm, as you probably gather from my conversation here. We have CPAs and enrolled agents who are actively working with individual stock market traders, teaching them how to reduce taxes on their trading. I mean, I think that's really important that whenever you deal with a professional association, that you have both the tax and legal side, and more importantly, that they understand what it is you're doing. In addition to that, we also have a retirement planning practice. We have an RIA that we work with individual investors to help them save money for retirement. And I'm going to talk about some strategies today that you may not be aware of, how you can gain control over your retirement funds and do a little more with them, and in ways in which you may have not been exposed to before. So there's a lot that goes on in Anderson. It's mainly designed to help individual investors ensure that they're protecting their assets, they're reducing their taxes, and then we're finding strategies to help save for your retirement. Okay, let me talk about the trader dilemma. If you're a trader in the market, you really have only 3 options that are available to you. Most of us fall into the do nothing and continue to trade in your own name category. That's because you haven't been exposed to different planning opportunities. If you're this individual, then you're considered to be an investor. That is, you have the brokerage account, it's in your own name, and you're out there, you're trading, and you're not going to receive any types of tax deductions. In fact, this slide exemplifies that the IRS doesn't give you any respect. If you're an investor, you have no deductions, and you're for sure going to be taxed at the highest rate that is out there for your trades. That is, if you're a long-term investor, then you're going to be paying tax rates at 20% on your long-term trades. Your short-term trades are all going to be treated as ordinary income to you. And at the same time, as I stated, you're not going to have any deductions available. So, those monies that you're spending for your feeds, for your education, if you're working with any types of organizations, and in your travel expenses, those are non-deductible. The computers, the screens that you acquire to create your trading area, possibly in your house, being able to write off a room, taking a home office business deduction. None of that is going to be available to you as an individual investor. So we want to look outside of that category because this is a expensive approach to trading. That is why go down a road where you cannot write anything off. If the IRS is going to give you another option, if all you had to do is change what you're doing today, why not take advantage of it? Because when you change what you're doing, that is, you're creating something different and putting that brokerage account into a different account name, and you're able to open up the possibility to write off and the potential to deduct certain expenses that are non-deductible to you right now, I think it's a no-brainer. I mean, it's something that when you look at it, you're still going to do the same thing you're doing today. That is, you're still going to make your trades. You're still going to handle the income in the same manner, but it's going to change how it's taxed to you. So the do nothing investor approach is there's this presumption that you're married to your stocks, and that, as I stated, all your income is unearned. And when you have unearned income, there's another limitation. You can't use it to make contributions to IRAs or to solo 401ks or profit sharing plans, because in order to do that, you must have earned income. And as an investor, the income itself is unearned to you. It's long-term capital gains or short-term capital gains. So you're limited on what you can do with that income. In addition to that, your expenses that we talked about are limited as well. So unearned income, we can't use it to offset our expenses that we've incurred to build our trading knowledge, to create what we were doing inside of our accounts where we are today. Those expenses you're incurring non-deductible to you. In addition to that, you have a floor limitation on deductions. So when you're trying to write off certain expenses, medical expenses and other things against this income, you may be able to write it off in certain situations, but there's going to be this 2% floor limitation. So meaning you have to incur quite a bit of expense before you even meet a threshold where you can begin to take a deduction. Another concern you have, especially from the legal side, is that you have no asset protection for your account. When your account's in your own name, there are a tremendous amount of threats out there. They say the average individual will be involved in 5 lawsuits during their lifetime. But when you think about that, if you were sued just even once and a judgment's entered against you, what could the creditor collect with that judgment? Well, if you have a brokerage account in your own name, that's fully exposed to your potential creditors. And when you think about liability, and I said the 5 lawsuits during your lifetime, car accidents is a big one. Things that you do, contracts that you sign, you could be sued for that. If they go south, if you buy a piece of property and it turns out that it didn't work out in your favor, maybe it's contaminated and you don't want to pay for the cleanup, even though the state imposes the cleanup fee on you, so you try to walk away and then you're sued, there's a potential. How about children? I mean, children are one of the greatest threats to our financial well-being. As long as they're living in the house and they're driving your car around, you're responsible for those children, especially even when they're in college. I met an individual one time that told me a very sad story. They sent their son off to college in the first year. While he was at college, he was driving the car and he struck somebody in an intersection and severely disabled them. In fact, they became a paraplegic, and they lost their entire retirement account. That is their brokerage account. The monies that they'd been saving for retirement, that they've been building up through their trading, it was all wiped out because of that one lawsuit. So it's things like this that come out of the blue, which is why you need asset protection to ensure that that brokerage account that you're working so hard to increase in value does not disappear with one potential lawsuit. And so as an investor, you need to get out of this keeping it all in my own name approach. You need asset protection for this very valuable asset that you're working on growing. Okay. The other aspect about being an individual investor is that all your trades get reported on Schedule D. Yes, that's a requirement now, that when you're a trader, and depending on the number of trades you're engaged in, you have to list out each and every trade on your Schedule D. So you have to provide that to the IRS when you file your tax return. I'm of the mindset that when you give a lot of information to someone such as the IRS, there's a greater potential for error. That is either error in reporting on your part or error in understanding what it is on their part. So what we want to do is ensure that can we minimize that? Can we disclose less, therefore reducing the likelihood that we could potentially find ourselves in an audit. I myself have been through an audit before, directly as a result of my success that I had in trading. From my active option trades, the IRS, when they reviewed my return, they looked at my schedules. They did not understand, the agent who audited me, how trades work and how options work. They assumed that I owned all of those stocks, and they thought that I was hiding income and underreporting that as my income. And so that was a little uncomfortable. I had to go through this audit. Thankfully had great representation, and it got it to go away. But that's a problem. When you have to disclose a lot of information, you increase the level of scrutiny because you don't look like everyone else if you're an active trader. When you're actively trading now, your return will be different because of the amount of information that's being provided versus, say, your neighbor who maybe only makes 7 trades a year or is in a mutual fund. So you have to keep that and take that in consideration as well, that if you want to trade and you don't want to disclose that information, there is a way to do that. And a lot of people who do not deal with traders, who are not traders, that have not been exposed to this, then they're just not going to give you this type of information. So you want to know that there are other options out there. Now, the do nothing approach, trading in your own name, okay, we can see that there's a problem with that and that you should look for other solutions. Now, one of the other solutions we have is to become an active trader, qualify as a trader in the stock market. Now, what does it take to qualify as a trader? Well, in order to qualify as a trader, or obtain what we call trader status, it's really based on your level of activity in the market. Now, the reason why people want trader status is so that now they can write off their expenses. If you can meet trader status, then you can deduct your trading related expenses on your 1040, or you could set up a corporation and write it off through an S corporation, deduct your trading expenses. So I've worked with individuals who look at this as an opportunity for them. They think, wouldn't it be great if, since I'm doing a lot of trading, if I could write off those expenses without having to get too complicated? Well, unfortunately, you have to understand what is required of you in order to take these deductions. Well, there are some cases out there, and pursuant to IRS Topic 429, a trader must seek profit from daily market movement. So what we're looking for is at least 3 to 5 round-trip trades a day, because that's somebody who is actively engaged in trading. It's not the individual who buys a stock and holds on to it for 3 or 4 months and writes covered calls against it and lets them expire. Now, this is a situation where you are actively in and out of certain positions on a daily basis, and you're seeking profit from short-term market movement. You've heard the word scalping before. This is what they're referring to. In addition, your trades have to be substantial. This number has changed over time. The number that we typically utilize now is at least 500 to preferably to 1,000 trades a year if you want to qualify as a trader. So you can see there's a lot that you must be doing in the market. It must be on a regular and continuous basis. That is, once you start trading, you can't trade for 7 months and then say, well, I've made so much money this year in the market, I'm going to take some time off. Or the market's turned and I don't understand how to trade this type of market, so I'm going to stop trading for a while and then I'm going to pick it back up again after I've paper traded and figured it out. No, a trader trades on a regular and continuous basis. That is, they do not have stops for long periods of time. Yes, you can take vacations and things like that, but generally speaking, you have to treat it as a job. That is, all of your trading is done just like it would if you're working for somebody else. You show up in the morning, you make your trades, you study the markets, and then you quit in the afternoons. In addition to that, your trades must be short term. So the majority of your income from your trading has to come from short-term trades. As I stated before, we want to see income from daily market movements. Majority of your trades have to be less than 30 days in order to qualify as a trader. You need to spend or keep track of the time you spend trading as well. You must keep track of a log so you can show that you're putting in substantial time for this activity. You just can't assume that if you put in 3 trades a day and you only spend 10 minutes at it, setting those trades up and then another 10 minutes getting out of them, at the end of the day that you're now going to qualify for this. If you want trader status, then you have to actually show that you put forth the time. You can't rely on others to make decisions. That is, you have to be the one handling all of your trading. It can't be done by third parties. So there have been cases where an individual spent a lot of time, set up his own little trading house. That is, he had this casita next to his house, and he created a trading room essentially in this casita. And then he brought in individuals to work for him, and he set up and had an S corporation. He paid him a salary, and he took his brokerage account, and he said, all right, you're going to work on the Forex, you're going to be doing commodities. These are individuals that he employed and paid them a salary, and he himself maybe took some option strategies. But over 3 years, he had a considerable number of trades, he had a considerable amount of income, and he had a considerable amount of expenses. The IRS denied him the ability to write off all those expenses because they stated he was not a trader, because he relied on the decisions of others to help him put his trades in. Now, if you think about it, every business hires people, and this person is no different. He hired people and paid them a salary. I think it'd be, the IRS would challenge me if I said that my law firm, that I'm not in business as an attorney and my income is not active because I rely upon others to help me make money. No, they would say you're an active business. And this is a problem with this trader status, is that there isn't anything in the Internal Revenue Code that defines what a trader is. So we have to rely upon legal decisions where the court has looked at these factors and determines on a case-by-case basis whether or not they're going to grant trader status to the individual. So that's a problem. And then finally, this has to be your sole or primary source of income. This is what catches a lot of people. They believe that they can trade in the morning, set everything up, go to work, earn a living like you traditionally do, and then come back and that the next day repeat this process over and over again, and they can qualify as a trader. Unfortunately, the IRS will not permit that. They want this to be your sole job. So you'd basically have to quit your current employment and show that all you want to focus on is trading going forwards. So that's an important qualification if you want to be a trader. And again, the reason why you would choose trader status is for the deductions. That is, the ability to write off your expenses associated with your trading. The home office, the computers, the multiple monitors that you may use. And I'll show you some other examples of deductions as we go on. But trying to meet that status is extremely difficult. And on top of that, the other problem with choosing trader status, assuming, for instance, that you are listening to me talk about these factors and you think, you know what, Clint, I qualify as a trader. Well, the problem is that when you file your tax return, you're most likely going to get audited. And that's why we see a lot of trader tax cases or individuals being denied trader status, that is. Not many of them appeal it because it's not worth it to them. But the reason why they get denied is because of the way the tax return is prepared. When you're a trader, if you do it in your own name and you do not set up an S corporation and make the election, then all of your income from your trades will appear on your Schedule D. So you show all this income on Schedule D from your trading. Now, your expenses will show up on your Schedule C. Now, if you're not familiar with tax returns, what does this mean? Well, a Schedule C is a sole proprietor. So what you're telling the IRS when you list all your expenses on Schedule C is that I'm a sole proprietor in a particular line of business. But all they see are losses, expenses. They don't see any income with that business. When you file a Schedule D, that's what investors file. And that's where your income from your trades show up. So what you're telling them is that you have created a business that makes no money here and that you're an investor because you show income on Schedule D. What does that do? Well, that invites an audit because the service assumes that you've created a hobby and that hobby is not generating income. And when you have a hobby that doesn't generate income, then you cannot use those losses, those expenses, to offset other forms of income, such as the income that shows up on Schedule D. So this is the problem for traders. The dilemma is that your income gets reported on one schedule and the expenses get reported on a different schedule. The IRS wants to see both the income and the expenses on the same schedule, but unfortunately you cannot do that. So it gives a rise to an audit. Now, when traders are audited, and that is they're doing this in their name and they're audited, few of them appeal it. And those that do typically lose. Now here's an example. This individual, in this particular case, again, he didn't trade. He only traded part-time during the year, and they said that he did not qualify for trader status, and he had another job. So in the Endicott case and the Nelson case, both of them did not trade full time throughout the year. And so even though they had substantial trades and they made a lot of short-term trades, the IRS denied them trader status because their trading was not regular and continuous. So you can have a ton of trades. Let's say you did 1,000 trades, but those trades only took place in the first 7 months of the year. You still won't qualify as a trader. So you can see here all the expenses that they had and the income. So it wasn't their sole source of income. And so these are the reasons why the IRS came in and denied these individuals trader tax status for their trades. I mean, look at this first one, 525 trades over 121 days, netting $470,000 in income. I mean, that's a considerable amount of income. You'd say that this person, it would rise to the level of trader status potentially. But again, it was only 121 days. Or you have 325 trades over 66 days. Again, that didn't meet it. So you can see what's going on here. I talked about the expenses showing up on Schedule C. Well, this particular individual listed $504,000 of Schedule C expenses and $303,000 in 2006. And so the income then did not show up on the same schedule, showed up on Schedule D. All the expenses were on Schedule C. And so they're really trying to write off all of their income from these Schedule C expenses without any income associated with it on that same schedule. That's what triggered the audit in this particular case. So trader qualification, not a trader, it's a problem. Here's the example of the situation where the individual engaged in quite a few trades and he had hired individuals. This one was the Mayer case I recently referred to. And what you can see here, he had 1,100 trades one year, 1,500 trades the second year, and another 1,100 trades after that. And he had gross receipts of 16, 18, and $14 million respectively. This is a classic example where somebody should be listed as a trader because they are hiring people, but the IRS found that because he hired employees to work for him to help him with his trading, he was not considered to be a trader. And so when I talk to individuals, they tell me, I think I want to qualify for trader status so I can write off my expenses and receive some tax deductions from my investing. I look at them and I think, the likelihood of you claiming trader status and having it upheld is as likely as me seeing this individual when I go out for a walk with my wife in the woods. All right. It's Bigfoot. That's what it comes down to. I've yet to see someone qualify for trader status. And most, as I say, in these cases, they get audited because of the way the income gets listed. So it's a difficult test to meet, and you're required to, trade on a regular and continuous basis, have so many trades a year, and they all have to be short-term trades. Why limit yourself in your trading or put these types of constraints upon you when there is a better way? That is, you can create your own trading business. Now, when you create a trading business, what you're doing is you're basically telling the IRS is that you're not going to play by their rules any longer. I'm not going to be subject to the IRS and the court system determining whether I need trader status. I want to work under the Internal Revenue Code. I want to say I'm going to put a business together based on the Internal Revenue Code and take legitimate deductions that are available to all businesses. Now, in order to do that, of course, you have to create a formal business structure. The advantage of creating a formal business structure is that you take it off your personal tax return. Now we run that activity through a business structure that doesn't flow down to you where the expenses are taken, so we don't have the Schedule C versus Schedule D problem. We're moving the expenses off of your individual return. When you create a formal business, you're going to provide asset protection, which is another concern that we previously spoke about, is that if this is your brokerage account and you're saving all this money, and you plan to retire upon that in the future, you don't want it to be subject to any risk. Most of us are scared to take on risk because we don't put boundaries around our assets, our more valuable assets. So then we will oftentimes limit what we do in life. Example I use, because I'm also a real estate investor, is that when people or banks ask me for a personal guarantee, I often chuckle to myself, because if they only knew that that personal guarantee isn't worth anything, Because if they were to come after me, let's say I had a default on a property for whatever reason, and they get a judgment against me, it doesn't matter they have that judgment against me. It matters only to them what they can collect. But since I've structured myself in such a manner with limited liability companies and corporations and limited partnerships to hold my assets, there's very little in my own name that a judgment creditor could obtain with that judgment. And so the personal guarantee isn't a concern for me because I know that I'm able to take on this additional risk because my assets have been protected. And in fact, my brokerage account is in an entity to protect it from potential creditors. So the other benefit on this as well is that you don't have to list all of your trades. When you use a business entity, if it's set up the proper way, you don't have to worry about keeping track of all your trades because it's not required to be listed on your individual return any longer, because the trading now is taking place in a business entity. It's not taking place in your own name. So now you fall out of that requirement that individuals list all their trades on their Schedule D. The other reason why we want to create a business entity is so that you will obtain business deductions. There's a lot of deductions that are available to businesses that are not available to individuals. In addition to that, as a trader, if you don't make that trader status, then you have no deductions that are available to you. And those few that are, you have to meet that 2% floor limitation. So you have to spend a lot of money before you can even begin to take off any expenses. So what we want to do is we want to avoid this. We want to create earned income from our trading. One of the benefits of creating the earned income, of course, is that when you have a business structure, you can pay yourself a salary and then you can make a contribution to an IRA or to a retirement plan. As an individual, you're not going to be able to do that. You also want to, as I stated, avoid having to qualify for trader status, because when we create a business around our trading, trader status is no longer a concern for us because we're not trying to fall within this obscure definition that is always changing as the courts reinterpret what it means to be a trader. We fall now under the Internal Revenue Code, where we look at what it means to be a standardized business. Now, what do we do when it comes, or how do we set up these businesses? I'm going to draw something out here. What we'll typically do for people who want to create a trading business is we will establish a C corporation. This will be your C corporation right here. And this is what's going to be a management company. So you're not going to trade out of your C corporation. It's going to be a management company where you and your spouse, if you're married, you'll be employees of this company. You'll work for it. You'll be an officer and director. But what is it going to manage? Well, it's going to manage your brokerage account. Now, it's not going to manage your brokerage account in your own name because, again, if we put the brokerage account in your personal name, then you're an investor and you're paying your corporation to manage that investment account. And then all the income will flow onto your Schedule D, and the money you're paying your corporation will not be deductible to you. So what we want to do is we want to create an entity that will allow you to deduct your expenses, number one, and also provide asset protection for your account. And the entity we choose for that is a limited partnership, an LP. And this is where your brokerage account will be located. And you and your spouse, again, you will own the interest in this limited partnership. You'll be the owners of it. The limited partners is what we refer to them as. And so you'll make all your trades in the name of the brokerage account. So when I told you earlier that nothing really changes, it doesn't. All you'll do is open up a new account in the name of this limited partnership and roll your existing account in. It's seamless. I've done this. I mean, I have 2 accounts open in the name of my entity that I trade out of. And all I had to do was open a new account, fill out an application for my business entity, and then all my positions transferred in. So when your money's in the LP, this is where the trades take place, down here in the limited partnership. In addition to that, we are going to create a management agreement between the corporation and the LP. Now, this is key to making this strategy produce benefits for you, so we can then talk about deductions, what you can write off. So the management agreement is something that you specify, that is, what amount of money will this limited partnership pay the corporation to manage this account? Because just if you're hiring somebody else to manage your affairs, your limited partnership can hire your corporation and pay it a fee to manage it, because you're making all the trades up here as the officers and directors. You're directing this company, because this corporation is what's called the general partner of this limited partnership. When you think of generals, what do? They tell the soldiers where they're going to go, who they're going to fight, and how they're going to get there. Well, in your case, you're the general that's telling the limited partnership how the trades are going to be made. Now, the way we'll set these structures up is that we will come up with a management fee. Let's assume that it's either a percentage or a flat fee. Maybe a lot of times my clients will set it up possibly $800 a month is what they'll start with as a management fee. So this limited partnership here each month will pay the corporation, it's $800. So now we're getting some income flowing into the corporation. On top of that, we'll give the corporation a 10% ownership interest in the LP. So if your trading account this year generates for you $40,000, say you make $40,000 in income, after you've paid your management fee, by the way. So this is the money that's left over after you've paid that $800 a month. So if you want to throw that in on top of it, you probably make closer to $50,000. So 10% of this, which is $4,000, would be the profits that would be also flowing up into the corporation for that 10% ownership interest it has in the limited partnership. So if we were to look at the numbers a little different way, what you would have here is that if I made $50,000 from my trading, all right, and I'm just going to round off the numbers, and I paid $10,000 in a management fee to my corporation, then I also took out I also paid it a 10% profit share of $4,000 as well. So that leaves me with $36,000 remaining in this limited partnership for tax purposes. A limited partnership is a flow-through entity. So this amount right here would be then taxed down to you at your individual tax bracket. But remember, you generated $50,000, but you're only paying tax on $36,000. You see the benefit here now? Let's assume that your income tax bracket for you and your spouse is a 30% income tax. You're in a 30% bracket. Well, you just took $14,000 off of your bracket at 30%. That's about a $4,200 tax savings right there for you. If you can save $4,200 a year by changing the way you conduct your business, your trading, you multiply that out over 10 years, that's $42,000 that you're going to have in your pocket over 10 years as a result of changing just how you trade. All you're doing is you're changing how you trade by utilizing the power of business entities to reduce your taxes. This is what professionals, which the very wealthy people in our society have already realized. They have professionals helping them. People often wonder, well, how is it that person pays so little in tax? It's because they've spent the time and the effort to work with professionals who understand their business to structure them properly. I often tell people about when I first got started, and I started my own business. First year, I made about $60,000. The second year, I was up to close to $120,000. The fourth month of my third year in business, I made $1 million in that month, gross revenue. That year was one of my most successful years. In that particular year, I paid zero in income tax. How did I do that? By planning. I planned accordingly. I put structures in place. I took advantage of the tax code to ensure that I was claiming every available deduction out there. That is achievable. Now, you can't do it every year, but you have opportunities here if you know what's available to you and you take steps to ensure that you're reducing your income. I've just shown you a simple way to put $40,000 in your pocket over 10 years. What does that buy? Let's say that you want to send your child to college. That's 2 years potentially of tuition right there, or it could be 1 year depending on where they're going to go. But you see the numbers over time, it all starts to add up, and that's money back in your pocket because you're not paying tax on it. We're moving that into the corporation. It's not taxed down to you, and we haven't begun to talk about what the corporation is going to do with that money yet. So that's the advantage of using this type of structure, is that you're creating tax deductions or the ability to write off expenses. You're not creating tax deductions, you're creating the ability to write off your expenses by how you've structured your investments. All right. Let's go on. If you were going to be an investor and you weren't interested in this tax planning, then we have a different structure for you. Let's assume that you look at this and you think, well, I'm not quite to that point yet. The numbers Clint put up there doesn't really apply to me. Well, then in that case, what you should do is create a limited liability company, which is called an LLC, and put your brokerage account in the name of the LLC and trade in there. The reason I recommend the LLC is that you need asset protection. You want to protect yourself. Put the assets in the LLC. And if something were to happen to you, so say you're down here and you're involved in a lawsuit and somebody sues you, they will not be able to take this ownership interest in your limited liability company. The law prohibits a creditor of a member, that's what you are, from taking the member's interest. So if they can't take your ownership interest, then they can't touch your money held inside of the LLC. And in this case, you're up here, you serve as the manager of your LLC. So all of you control the trades just like you do in the other structure I gave you, but you just don't have that tax component to it, the C corporation, which gives you the ability to write off your expenses. This is more of an asset protection structure, not necessarily a tax planning structure. All right. So we talked about how the money flows. Okay, again, you run management fee up to the corporation, and that's based upon the profit of your trading account. Now, you get the money up in the corporation, and then what you're going to do with it? Well, in a word or two words, spend it. All right, here are the different things you can spend it on. That is, you can write off when the money flows into your corporation. You can write off your newsletters that you subscribe to, data feed, subscription. You can collect or write off your home office. You can depreciate your equipment under Section 179. That is, you can write off to $25,000 in computers. If you have internet, of course, I mean, depending on the speeds, that can be $100 a month for some people. If you're looking at gigabit speed internet, say through Comcast, that's a deduction to you. Travel, that is when you travel to your seminars. If you attend trading seminars to, bone up on your trades, look for different strategies, understand how the markets change, what you need to do to change your trading. Well, the travel you take to those events will become deductible to you. The education that you pay for to attend those events, that's a deductible expense. The hotel stays, the meals while you're there are deductible. If you say you go to a show while you're at a trading convention, that evening you head out to a show, that becomes a deductible expense as an entertainment deduction. So you can write off a lot of things through that corporation that ordinarily, you're spending that money right now, but what you're doing is you're earning it, you're paying tax on it, and then you're spending it. What I'm suggesting you do is you earn it, spend it, and pay tax on whatever is left. So you have accounting and legal, that's a deduction. So this is a big thing that I often tell people. It's like the cost to even set it up is fully tax deductible to you. The startup fees, all tax deductible. Supplies, bank fees, professional advice that you bring in through the business to talk, to advise you on how to run your trading business, that's a tax deduction to you as well. So when you create a trading business, what you're doing is you're opening up the tax code. You're now taking your business and putting yourself in a situation where you can take advantage of it, because as a sole proprietor or an investor, you do not have this ability. Medical, I mean, that's on everybody's mind right now with the election and what's coming up, talking about whether or not they want to rescind Obamacare. Well, that wouldn't be a concern to me so much, because if I had a business set up, I can reimburse myself for my medical expenses, for my dental expenses, for my vision expenses, those out-of-pocket costs that are not covered by your insurance company. Those become deductible expenses to you if you set up your business, of course, the proper way. Now, let me just show you how that might work. So here's my corporation again. It earns $10,000 in income from my limited partnership. So I have education expenses of $10,000. I have $2,000 in travel for the year. I have $1,000 in lodging when I'm attending the event. Let's say I buy a new computer. So net out, I have $14,500 in expenses in year one. Now, I will reimburse myself $10,000 to pick up these expenses, because I assume that if you haven't created your business yet, and this is what I'm talking about here, this year, if you think back, if you've kept track of all the expenses you've had with respect to your trading, with the education that you have, and the travel and in the computers, those expenses can be captured if we get a corporation set up for you before the end of the year. And the way we do it is we create your business now, then we bundle up all those expenses and we make them part of your business as a startup expense. So when your corporation generates money, it needs to reimburse you. And so in my example right here, what I was showing you is that the corporation has $10,000 in income, and that came from managing the limited partnership. And so it has also $14,500 in expenses it needs to reimburse these individuals right here, the people who incurred these expenses, the owners of the business. So it's going to pay them $10,000. Now, it's not going to be a salary. It's not a distribution. It's not a dividend. This is a reimbursement. Think of it as if your employer asked you to go buy a computer for them, a new laptop, and you picked one up and it was $2,000. You come to your employer and you give him the laptop and he writes you a check for $2,000. That's a deduction to the employer. It's not income to you. So this is what we're structuring here, is a situation where you've incurred the expenses on behalf of your business. So then you're free then to be reimbursed from your business, and your business gets to write it off. So in my example, continuing on, if the corporation earns $10,000 in income, you take off the $14,500 in expense, it still leaves you with a net deficit there. You still have a loss because you didn't earn enough money to fully reimburse yourself. So this gets carried forwards. So let's assume next year you make in fees, your corporation generates $15,000 in income from charging your limited partnership. Well, right away we have that $4,500 that's carried over from the prior year that we can then pay out to you. So that leaves us then with $11,500 remaining inside the corporation. I assume you're going to have more expenses going forwards, and let's assume that your expenses going forward amounted to $8,000 in expenses. So now that brings us down to $3,500 that remains inside of our corporation. So what do? Well, now your corporation is going to have to pay tax because it has some profit that year. But the tax rate for C corporations is 15%. That's your tax rate on that money right there. If you're under $50,000, you're going to pay a flat tax at 15%. That's pretty low. I mean, I don't know where else you're going to go to find that type of tax rate unless you just quit working and make very little money. So now our corporation is there, and it can then generate some additional profits, and it gets taxed at this very low rate. That's basically half of what a lot of people pay in taxes. You just cut your tax rate on half an income that the government would have taken 100% more of had you earned that money in your own name. Now, if you don't want to pay any tax on that money, and you want to be ensured that create additional opportunities for yourself to expense out just beyond your education expenses, your travel, your meals, your lodging, your home office deductions and equipment and everything else we've been talking about, why don't you create one of these? Create your own retirement plan. You can create your own retirement plan, self-directed pension plan, where you're the trustee, and then you can begin making contributions to it. That is, your corporation can make contributions to your own plan. You can pay yourself a salary, and if you wanted, you could then contribute that salary under a 401k into your own profit sharing plan or solo 401k plan, and that's a fully tax deductible to you. So in my previous example, we had that $3,500 that was remaining in the corporation. What I would have done is paid it out to myself in a salary, and then I would contribute it to a solo 401k, the entire amount. So that way I moved it out of my corporation. Salary is a deduction, okay, just like when you pay wages to somebody, and then you in turn put it into your 401k plan, and that's a deduction to you. So we use your personal deduction then of a 401k contribution to net out the corporation, so there's zero taxes there and there's zero taxes on you because you contributed that money to a 401k. Now, the nice thing about having your own pension plan like this is that when you create a plan, unlike those that maybe you're trading right now in an IRA, or you have money with a previous employer in their 401k, what's the problem you face? Number one, if you're with a prior employer's 401k plan, all you can do is invest in the mutual funds that they offer you, so it restricts your daily trading. Two, if you're dealing with an IRA, you're limited in what you can do with your trading account as well. Now, you might be thinking, no, I'm not, Clint. I can buy and sell stocks. I can trade options. Well, it depends. When you have a trading account, when you create your own pension account, you have full trading capability. And what that means is that you can trade on margin inside of your account. How many of you have ever been able to trade on margin inside of your IRA? You can't. Now, you might be thinking to yourself, well, how does an IRA pertain to my pension account, Clint? Because it seems like they're two separate accounts. They are right now, but if you create a business like this, like I'm talking about with your corporation, you set that up, and then you create a pension account over here, a pension plan, you can take your, let me get rid of this here. You can take your existing IRAs that you have, and you can't do this with a Roth, but let's say you and your wife, you have some IRAs you've set up or 401ks with other employers, you can roll them into this new account right here. Yeah, direct rollover, it's non-taxable, it's a qualified rollover, and then you can then pool all of those funds into one account, or you can have two accounts inside of the plan, or many as you want actually. Now, when they're inside of the plan, you fall under a different set of rules. IRAs are under one section of the Internal Revenue Code. Pensions have a different section when it comes to governing how income works inside of the plans. IRAs, you can't trade on margin, but in a pension, you can utilize margin. And so let's assume that not only are you trading, but you're also looking to invest in other types of alternative investments. In an IRA, you could find tax on those types of investments if there's any debt associated with it, but you don't have that problem in a pension. You can even partner with your plan to do certain types of deals. That's something that you would have run into problems with an IRA. A lot of times people tell me, you know, Glenn, I want to build my trading portfolio in my own name, but I have so much money locked in a pension and I just don't have access to it, because if I were to take out the money out of my IRA, I have to pay, you know, income tax on it, and I have to pay 10% early withdrawal tax. Well, with a pension plan, you can borrow from your plan. Yeah, each individual participant can borrow up to $50,000 out of their plan, and then they can use that money to contribute into their limited partnership, into their personal brokerage account, and start trading it and generating money outside of the retirement plan. So you're given this flexibility. I mean, think of it this way. Let's assume that you had $200,000 in this IRA over here. You can't take $50,000 out. Well, you could, but you have to repay it in 60 days. But if all you did was create this little box right here and you rolled that money in, now you can pull that money out because you've changed how the account is held. Again, same way with the taxes. You're changing how you hold your accounts and how you treat your income. When you make changes to your accounts in the manner in which I'm describing, you're opening up opportunities for yourself. Most people are unaware of this information, and hence they continue to do things in their own name. They continue to make the same mistakes year after year and overpay on their taxes. Everyone's obligated to pay income taxes in this country, but you're not obligated to give them a tip when you're paying. And you do things in your own name, especially as a trader, you're essentially tipping the federal government because you've chosen not to take steps to give yourself the opportunities to write off certain expenses and keep more of what you've earned. So as I stated, you can also pool your accounts. You and your wife can have all your money in one account if you want to, so you don't have to trade out of multiple IRAs. And on top of this, as I touched on earlier, you can make contributions. Now, this $18,000 is that would go into your 401k plan. That's a contribution right there. But your corporation, depending on how much money you're making, how successful you are with your trading, it can dump in some more money for you as well into your plan, which would be fully tax deductible. With a pension plan, your total contributions can be up to $53,000 a year. It just astounds me when I see people and I ask them, how are you saving for retirement, especially traders, and they say, well, I'm maxing out an IRA every year. Stop doing that. There's no reason why you have to be contributing to an IRA. I mean, you could continue if you want to, but why not give yourselves the ability to put away more so that if you're trading in these retirement plans, it's not taxable to you until you pull it out. Here's an example of how that works. You have your business, you pay yourself a salary out of that business. Then your business can put money into the plan, and you can also contribute money to the plan. And depending on how much money you're earning, it could be all tax deductible to you. So taking advantage of pension plans, especially a solo 401k with that even has a Roth component to it, it gives you options. See, everything about planning is knowing that you have options, that you can do certain things if you have the proper structure in place. If you don't, then you cannot take advantage of these opportunities when they come along because you're not prepared for it. So many of the things that we've been discussing during this webinar, I don't expect them all to apply to you today, right now, but when you're ready to take advantage of it, you have the proper structure in place. So when the opportunity presents itself, you can execute. You know, it's just like when it comes to trading. You set up your trades, you look for certain indicators so you can get in and get out of the market. It's the same when it comes to tax planning, business planning, asset protection planning. You need these tools in place to give yourself the opportunities to execute when the opportunity is presented. Now, the last thing I want to leave you with here is the most important piece of structuring, and that is estate planning. You know, most people get all jazzed up about the corporations and limited partnerships, and they think of, you know, I want to start saving money right away with my trading by putting together a corporation and writing things off. I want to gain asset protection. Yeah, I'm looking at my kids and they're driving around now, and it makes me a little concerned, and I don't want to risk all my assets, my retirement savings to their potential liabilities. But they don't think about estate planning. Well, the fact of the matter is, we're all going to pass away at some point in time. And the question is that what type of legacy are you going to leave in your wake? That is, are you going to leave a legacy of peace for your family, that you're going to make it easy for them after you've passed on, that it's not going to be chaos, people are not going to be fighting, you're not going to have to hire an attorneys who are going to get involved and basically not liquidate your estate, but, you know, spend a fair portion of it to administer your estate? Or you can set something up that makes it extremely easy for them so that the transition of you out of their lives is not as difficult as it could have been depending on the type of plan you set up. The reason I feel so important about this topic is that both sides of my family were destroyed over estate disputes. And those estate disputes were set up because they each had a will. And when it comes to planning for your estate, you should at all costs avoid utilizing a will. I mean, if you don't have anything in place, it's better than nothing. But so many people believe that the will is a proper way to plan for the estate because that's what their parents have done or did. And they don't know any better because most attorneys are not going to tell you that you have other options. They're going to oftentimes convince you, you need a will. When you go in, and even if you know that there's other options available to you, they'll still try to steer you towards the will because the will is a loss leader for them. It's a retirement plan for attorneys. And what I mean by that is that when you pass away with a will, everything you own in your own name must go through probate. Now, who do you think is going to handle that? It's going to be the attorney. Typically, it's the attorney that drafted the will that's going to get the probate because many attorneys will not give their clients their original will. They're going to keep them, and they're going to keep it. They'll tell you as a goodness of your heart to ensure that the will is protected, that it's a legal document. You don't want to lose it because then you have to redraft it. And so they have a system set up to ensure that the original will always be preserved for you. In reality, what they're saying is that when you pass on, your kids need the original will. They're going to have to come back to my office, and then I'm going to sign them up, and I'm going to grab the probate. And that's where I'm going to start making my money. My grandfather practiced law for 50 years, and he set up a tremendous amount of wills. And what he did when he was ready to retire, he sold his practice. And a good portion of the value of his practice were all the wills that he drafted that he still held on to, these original wills. That comprised the majority of the value of his practice when he sold it. And if his associate didn't want to buy it, he would have sold it to somebody else. I started practicing when my grandfather was retiring, and he talked to me about it. He said, if you're interested in probate work, he goes, I have a lot of wills here. We can work out some type of deal with this if you'd like. I didn't take him up on it because that's not what my practice is based upon. We avoid probate. The way we work with our clients is like, why do you want to be in the situation where an attorney is going to be involved with the administration of the estate, that you've turned it over to the court system and they're allowed to charge what they call to be their reasonable fee, or in some states they get to charge a percentage of your gross estate. And then on top of that, it can take an extremely long amount of time to handle the probate process. They say the average estate takes takes 18 months to probate. And that's pretty typical. I know that the few probates that I've handled, typically it's been done for family members. As I stated, both sides of my family were destroyed over probate. I handled my grandmother's estate, and my uncle, who was the executor, it took him almost 5 years to distribute out 2 pieces of property and 5 bank accounts to his 2 brothers, because my uncle saw it as an opportunity to enrich himself. And that's what he did. He paid himself $70,000 in executor fees to handle this estate. Now, I was drug into it because my dad's told my uncle, he said, hey, Clint works for free now because he's an attorney and I paid for his law school, so he's permanent retainer for life. But it wasn't a good situation. I could see how the family relationships were going to unravel based upon my uncle's decision making. And of course, to this day, my dad has not talked to my brother or his brother, that is, in over 12 years. So you want to ensure that stuff like this is not going to happen when you've passed on. You don't want your children fighting. You don't want to bring attorneys into it. You want to keep it private. You want it to take place in an expeditious manner. And you don't want people to be able to contest what your wishes are, because when you open up probate, you've opened up a legal proceeding where people can contest it. Then you should at all costs avoid a will. And the last thing I'd mention here is that if you have property in more than one state, then you would want to for surely avoid a will, because everywhere where you own property, you're going to have to go through probate. Let's say I own property in Washington when I pass on, but I also have property in California. Then when I die in Washington, my family will probate my Washington property. Then they have to go to California and start the process all over again with another attorney. It's just far, far, far too expensive when it comes to estate planning. The far better solution is the living trust. Number one, the reason why you want to set up a living trust is that it avoids probate. That is, you don't have to have an attorney involved when you pass along, because if all of your assets are held in the living trust, when you pass, there's no probate. So the example I just left you with, owning property in 2 different states, well, that can be handled by your trustee, your successor trustee. Let's say I pass away in Washington, my wife's no longer living, and my son and daughter are named as my successor trustees. Well, they could then take the properties in California and Washington and deed them to themselves. They wouldn't have to get an attorney involved. Nothing would have to be submitted to probate, because it's considered to be a pre-death transfer. So when the attorneys, when they're taken out of the mix like this, they don't like it. And that's why so many attorneys will not tell their clients to set up a living trust. And they'll give them some excuse such as, your estate's not there yet. You don't have enough. You're not worth enough to consider a living trust. Well, my argument to that is that anybody who has real property, has an net estate valued at over $100,000, or has minor children, is a prime candidate for a living trust. Because as your estate grows, which I would assume that's why you're trading, that's why you're trying to build a better life for yourself and your loved ones. You want to create a lasting legacy for people. As it grows, so does the trust. It grows with you. You set it up the right way at the very beginning. You don't need to make changes to it, as people are often doing with wills, because the trust encompasses different aspects of your life. It's an overreaching document that ensures that all your assets will remain protected for your loved ones should something or when something happens to you. It also expedites the estate distributions out of a living trust, because you're not tied up. You're not on the court schedule. It's up to your successor trustees on how fast they want to proceed. In the case of my uncle, where he charged $70,000 to administer my grandmother's estate, if she would have allowed me to put together a trust for her, we could have specified that he would have earned no more than, say, $5,000, and we could have specified how soon he had to distribute out the assets. And if he didn't want to do it under those constraints, then someone else would have to step in and control that estate for her. Those are the types of things you can do inside of a living trust. If you have pets that you want to take care of, you can put aside assets for pets so that monies are used to continue the care and the love of your animals after you're gone. You want to make sure your children get an education. Well, you can do that through a trust, that if you pass on when your children are still young, that they just don't receive the assets outright, that they're held in trust for them to go through college, and then the money gets distributed out over time. I hear attorneys tell me, Clint, I can do all that in a will. Everything you just described can be done in a will. Of course it can. but you have to go through probate in order to get to that point. And then on top of it, what most people don't understand is that when you create your will in the manner in which I described, where you create a trust for pets or you create a trust for children, you can't close out the probate until that trust pays out all of its assets. So if that trust lasted 12 years, then that attorney will charge your estate for 12 years as he administers that estate before it gets closed out. So this is not the way to plan with a will. You need to have a living trust. On top of that, you minimize estate taxes inherent in a living trust. You ensure that you're minimizing both your state and your federal estate tax. So we capitalize on every available dollar for your children and for your loved ones. And the reason why you minimize family disputes with the living trust is because you address all these issues outright. You make sure that we're not putting children in a situation where they're pitted against one another. You put provisions in there so they understand why you're doing the things for them, and that when it comes to handling the estate, the person who is there is just basically following out your wishes. So you reduce the animosity by reducing the ambiguity that is oftentimes associated with wills, where people say, I want this person to distribute these assets to these people, and then period. Well, what are the terms? How are they going to be distributed? Under what time constraints? How much can they charge? These are all the things that get addressed in the living trust. And it is the best way to plan. Now, when you create an estate plan, of course, when you're putting together a living trust, you want to make sure that you have a pour-over will as a backup, because your trust is going to own all of your assets. So if you see here, your business, your corporation, your LP, all of that is going to be owned inside of your living trust. Your personal residence would be inside of your living trust. Your vehicles would go inside your living trust as well. Everything you own will be inside of here. So all of the assets in this box will be passed on per the instructions that go along with this box. Now, if you leave something out, let's say I left out a boat outside of my living trust. Well, that's why we put together a pour-over will as a backup document. So that asset would have to be probated, and at the conclusion of the probate, it would then be transferred into your living trust. So your trustees would be in control over these assets. The living trust also includes with it financial power of attorney, medical power of attorney, a living will. These are the things that are so important so that your loved ones can make medical decisions on your behalf if you're in an irreversible vegetative state, and that we don't have a situation where the hospital has every incentive to keep you on life support as a means to enrich themselves. So the living trust is the most important component. It is the foundation of all of your planning. It will be there for the rest of your life. It's for you and your spouse. If you're married, it ensures there's seamless transitions from one to the other. It does not create chaos in your wake. And by all accounts, it will minimize both costs and taxes after you're gone to preserve more for your family. Now, if you would like some assistance with any of the things that we talked about, at Anderson, we provide these types of documents or these types of structures. That's what we do for our clients. And for being on this webinar today, if you want to reach out to us, you can. I'd prefer that you reach out to my assistant. Her name is Deborah Lewis. You can reach her at dlewis, DLEWIS, at alglaw.com. So it's dlewis at alglaw.com. Send her an email, and if you reference that you were on this webinar, say I saw Clint on the tax webinar for traders today, if you reference that, we will provide you a free individualized consultation where we can talk about your trading and the appropriate business that you should consider, and estate planning as well, to help reduce your taxes and things you can do for now in 2015 that will get you a deduction. So going into 2016, you have the structure in place, so when the opportunities present themselves, you're ready to take advantage of them. If you email her that, we will then set you up with one of our consultants for a free consultation, and I will provide you $1,000 off. That's $1,000 off our services. Whatever structure that we're going to provide for you, you'll get $1,000 off, but you have to take action. You have to send her an email. You'll have till tomorrow if you want to take advantage of this to get the $1,000 off. If you don't send it to her by tomorrow, that's fine. You can still get a free consultation with us. But if you get her an email today, I will give you $1,000 off our services. It's coming up to the end of the year. It's my way of saying, all right, Here's a way for you to reduce your expenses even further, to pick up additional deductions. Take advantage of this. Contact Deborah Lewis, dlewis at alglaw.com, and reference in there that you saw Clint on this webinar. We will get you a consultation. We will talk to you about what you should consider before the end of the year. Maybe you don't need anything, but at least you know, and you've dealt with a professional who understands what it is you're doing. Again, my name is Clint Coons. I'm attorney with Anderson Business Advisors and Law Group. I want to thank you for attending this webinar, and I want to thank Sandy for having me on again, because this is important information. Not a lot of people understand it. And by coming to this event or attending this webinar now, you've been enlightened as to the opportunities that exist for you. I wish you the very best, and I hope that you reach out to us and you give us the opportunity to show you what we can do for you in reducing your taxes and protecting your assets. Thank you very much, everyone.